Rob, we want to drill down on a little bit more around the reasons to invest in bonds. There's a recent article from PIMCO outlining 7 reasons why now is a good time to invest in core bonds. So can you elaborate on that and how you came to pick 7?
How did we end up with 7? Arguably we could have had more, but I thought seven's going to work better, just given what's been happening in markets over the past couple of years. And while it's a bit tongue-in-cheek in terms of the characterization, it's a heartfelt view that is valid, right? And it's not just a marketing marketing initiative. So uncertainty is certain, which means portfolios should be diversified. Like, it's not the time to back one particular investment with a high degree of confidence because things are uncertain. We also touched on yields are still high, right? So when yields are high, and as we talked about, it's like for years and years they weren't high. And so now they're high, 4, 5, 6, 7% for very high quality instruments. Diversification becomes even more of a no-brainer. One of the other reasons is, why do you diversify in a portfolio in the first place? You diversify because not all assets are perfectly correlated, right? You want to have either low levels of correlation or negative correlation in a portfolio in order to improve the risk-adjusted return, right? So you end up with higher return for lower risk. It's the one free lunch in investing. So when you think about what those sort of correlation properties have looked like historically, it's true that all assets became quite correlated, or at least positively correlated, when inflation was way above central bank targets. Because the most important driver of asset class returns was inflation. And if you look at history, when inflation comes back down into the target range, correlations go negative. And so we're moving into that phase right now where the power of portfolio diversification is returning. And so investors shouldn't ignore that. Like, it's something that, don't dismiss correlations based on a historical episode that's not being repeated. Think about where we're going rather than where we've been. Some other things that are clearly sort of driving those 7 as well is equities are expensive. And so they're less expensive than they were when we wrote that piece because markets have started to correct already. When we first published, they'd barely moved. They were still near highs, so there's some of that correction happening. But even if you're looking at PE ratios right now, they're still elevated, and suggesting that there's room for some disappointment broadly across global equity markets. Again, we're not talking about crashes. We're just talking about relative expected returns. Like, if you don't think equities can generate low double digits and you think bonds can generate mid to high single digits, then you shouldn't be 100% in one and nothing in the other. Final thing I'll say, and we can talk about some of the other of the 7 as well, is the hybrid market's disappearing. And so we know that they'll slowly get called, and investors need to replace that income in portfolios in some way. The really important thing about why hybrids were so popular, it was not because they were so risky. It was nothing to do with that. It was because they had franking credits. And so you don't want to replace a franking credit only with a really illiquid, say, private credit option. That should form part of the replacement, but not all of the replacement, because you don't want to replace franking with just risk. So that's when other core bonds, other high quality income opportunities become just a really compelling addition to investors' portfolios to replace that income stream that hybrids were providing historically.
Nice.
So Rob, I think you've done a great job of covering most of the 7 reasons, and just to recap some of them, core bond yields are high, developed market inflation is falling, cash rates are falling as a result, and equities are expensive. One that we didn't touch on, but I'd love to get a bit more colour on is how defaults and restructurings are accelerating. So there's people have probably seen a little bit in the media around that, but can you just give us some colour on that and why that leads to fixed income being a good investment?
One of the most important disciplines of of any form of bond investing, it can be in the private space or the public space, is to think about your returns after losses. So the more credit risk you take as you go down the credit curve, the higher probability of some losses in a portfolio. So you want to look at sort of loss-adjusted spreads. You don't think about just assuming that everything is money good. The more risk you take, some things it won't work out. And that's okay. There's nothing wrong with that. That's just you're getting paid a much higher return to compensate you for the probability of things don't go well. Yeah. And you're starting to see that very starkly in a couple of different sectors of the Australian economy. So you're seeing that in property development, and you're also seeing that in parts of hospitality. And so having too much concentration in those two sectors, we think is not a great thing to do. Thinking about other areas where you can deploy capital with similar expected yields, but much lower expected losses. And some of those opportunities are outside of Australia. So I think it's just one of those things, because there's no really deep high yield market in Australia. There's no sort of tradable bank loan market in Australia where there is in the US. You get your first leading indicator in those markets in the public space, because things start to default, the delinquencies go up. In Australia, it's almost all private.
Yeah.
So there's just not as much visibility on stresses that are materialising. And again, it's just a matter of being aware of that as an investor, being a little cautious, not abandoning the area completely, because there's plenty of great managers in that space. There's plenty of great opportunities, but just don't be too concentrated.
So with 7 magnificent reasons to invest in core bonds, the question is then how to determine which strategy. And with a variety of core fixed income strategies available, global versus Australia, how should an advisor incorporate fixed income into a portfolio and think through the various options?
Yeah, so there's sort of 2 really key things to think about. First is, do you want to be solely invested in Australia, or do you want to think more globally? And so the idea for PIMCO, and we've had these funds available for a very long time, and now they're available in ETF form to fit a different cohort of investor base, is to sort of think through that. Do you have enough global diversification in your broader portfolio? How do you think different bond markets around the world are likely to perform? So having a choice between those 2. Second thing is, we provide a pretty simple solution just to bolt the 2 together. So if you don't want to make that active decision as the end investor, you can buy a 50-50 version of Australian high quality and global high quality. And then in ETF form, we've also launched a high quality global credit variation. Global credit all hedged back to Australian dollars. So it really comes down to how they fit in a portfolio context, which is, because I don't have that visibility, it's hard to give very clear guidance. But there's a sort of courses for all the different particular solutions. In all of the cases, the yields in those opportunities are somewhere between sort of 5 and high 6s. And then we will launch additional ETFs in that space going forward as well.